How we doing? How we doing? This is Destination Denver, Colorado, and today the Denver housing market was one of the hottest markets in the entire country. Then it shifted to a cool down, to getting gut punched in March. In this video, I'm going to show you exactly what just happened to this market, what it costs you, who it affects, and whether Denver still makes sense if you're thinking of moving here. And we're starting right now. Welcome back. I'm Jimmy Everts, and this is Destination Denver, Colorado, where we cover all things eating, living, breathing, and experiencing the Denver metro area and Colorado Front Range. I'm also a licensed mortgage broker covering the entire state of Colorado. My number and email here on the screen if I can ever be of assistance to you as you plan your move to this beautiful state of ours. So at the beginning of every month, I like to look at what is going on in the housing market, kind of give you an idea of what is occurring. Most of the content you're going to see on this channel at the end of the day is about living here. But this is really about dealing on the financial side of what you can expect. And the Denver housing market, for the better part of 15 years, was as hot as it got. It was constantly ranked as one of the most popular destinations for people moving all over the country, up until the last 2 to 3 years where things really just started to cool down. In fact, Colorado saw a negative net migration last year, which was a pretty big gut punch. So today, we're not talking about a highlight reel, we're not talking about a spin, we're talking about the actual story. What is going on today? And I'm gonna give you a little background on why it's occurring. So we look at the month of February, the beautiful month of February, where it really looked like the market was finally waking up. And this is nationwide, not just in Denver. The Denver housing market was looking very promising. Pending sales had jumped nearly 30% month over month. The 30-year mortgage rate briefly touched 5.99%. That was the first time it had been below 6% on the average since the tail end of 2022. And buyers who had been sitting on the fence for multiple years were really starting to perk their ears up and get out there and hunt. And then, unfortunately, as you may be aware of already, March happened. So rates climbed back and fast. We went from 5.99% on February 27th to roughly 6.62% on the average fixed 30-year conventional as of the making of this video. So you're talking about more than half a point in 30 days. And on Denver's median home price, that affects a buyer by about $226 a month on their payment. So $226 in 30 days. But that rate spike is only part of the story. And again, not just in Denver, but nationally. And that's really what we're going to dive into. What has caused this situation here in Denver? So what do we need to cover to really have the full picture here? Well, we need to talk about where Denver's buyer pool went and why it's not coming back the way people expect. We need to talk about what just happened in March and exactly what it costs you. We need to talk about what the actual market looks like right now heading into the spring, and then we certainly need to talk about whether Denver still makes sense if you're thinking about moving here. At the end of the day, that's why the vast majority of you are tuning into this video in the first place. So to understand again how Denver got to where it is, we need to talk about where it was. So for nearly 15 years, as I mentioned, from basically 2008 till roughly 2022, Denver was growing. In fact, we had 6 consecutive years of double-digit appreciation from 2013 to 2018. That is not normal. You do not see double-digit appreciation in markets. It's unsustainable. And even during that period of time, I remember conversations during that period where we were all saying this can't keep happening. Then you had to add, rocket fuel to the fire. You had the pandemic era. So from March of 2020 to April of 2022, we had one of the fastest appreciating markets in U.S. history. Nearly 38.5% appreciation in the Denver metro area between March of 2020 and April of 2022. That is a staggering amount of appreciation. Homes were selling in 3 to 7 days. You had multiple offers, you had bidding wars, you had cash buyers skipping inspection. And the real question was, where was all of this fuel coming from? During the pandemic, as low as interest rates were, who was buying all these homes? And the fact was, it wasn't fundamentals, it was migration. We had California buyers who were cashing out equity in their state and moving here. You had Texas relocators who were looking for lower costs of living. And you had remote workers where all of a sudden location is no longer an issue. You don't have to live in this city or state where you're at. You can go wherever you want and people couldn't wait to get to Colorado. And this affected us in a couple different ways, because not only did you have people coming to the Denver metro area, but you also, and I dealt with a lot of people who lived in the Denver metro and they wanted to be in the foothills or they wanted to be in the mountains. So they took all their money from the city, moved into the mountains, replace them with people coming here from areas of California, Washington, D.C., Seattle, New York, high cost areas, moving here where they could get a deal on $1 million house. And you had this huge influx of cash. And the fact is that borrowed demand always eventually catches up to itself. So when the fuel source of migration slows down, and that is what occurred, the vast majority of people moving into the state slow down. At that point, the market is only as strong as the wave coming in, and Denver's wave stopped. It became, instead of a wave of migration in, it became a migration of people moving within the city. Now, the biggest shift really happened in 2024, now into the current day here in 2026. So between July of 24 and June of 2025, Colorado had net out migration of approximately 12,000 people. Again, that's not a plateau. It's not leveling out. That's a reversal. That is people leaving the state, something that was basically unheard of for the better part of 20 years in this state. Meanwhile, builders kept building homes. More supply on top of less demand was occurring, and that is not something that you're used to hearing. You are used to hearing there just aren't enough houses being built regardless. Now, the buyers who made up this 2021 and 2022 market, these buyers coming in with a lot of cash, a lot down, a lot of aggressive offers, they're not here anymore. And the buyers who are left face a completely different financial reality than the ones from just a couple years ago. And really, as much as I try not to focus on numbers on this channel, when we're talking about housing market, we have to look at the numbers. And this is really a number that explains it all. So the same $500,000 house that cost roughly $1,700 a month in 2021 at a 3% interest rate now costs $2,528 in today's rates. That's $840, basically $850 more today for the same $500,000 house that it cost back in 2021. To qualify for that payment, you need roughly $25,000 to $30,000 more in annual gross income than you did as a buyer in 2021. And I'm sure many of you have looked at your paychecks and have not seen a $25,000 increase in your pay over the last 5 years. Or at least not one that you can put straight to housing and not have to worry about any other bills that have gone up. And really, that's the number that people tended to talk about but kind of dodge. The market didn't just become more expensive. The qualifying bar got dramatically higher. That changed who could buy a house, who wanted to buy a house, and how the market in general would move. Now, I get asked a lot, so if these buyers aren't coming here, if they're not coming to Denver, where exactly are these days? Well, in looking at this, California buyers for existence, well, prices in California corrected too. The equity-driven move made less sense as time went by. Many also decided that instead of coming to Colorado, they would go to other cheaper Western states. So whereas Denver in the beginning of all this build was considered affordable, as it became less so, these California, as an example, movers started looking at other states to take their equity. Meanwhile, at the same time, the Texas economy stayed pretty strong. There was less reason to move there. Remote workers, that was a huge influx. And again, Denver wasn't just the only, wasn't the only city for this, but you had so many remote workers. Well, that pandemic, remote worker thing was really a one-time disruption. The live anywhere era, for the most part, has ended. There are still, certainly a lot of people who work remotely and they can move, but for the most part, that massive amount of people who were not going to the office, that's done. Most have been called back to the office. Location freedom goes away with that. So that buyer is no longer in the market. And the other key component to this that has been talked about a lot but really needs to be driven in is the fact that move-up buyers are the rate-locked crowd. These are people that own a house currently. Maybe they're sitting on a 2.5%, 3% mortgage. They locked it in 2020, 2021, and then when they look to upgrade right now, that could mean, heck, doubling their mortgage payment. And as much as they would like to have a bigger kitchen or they'd like to have an extra bedroom, as much as they would like things, unless they absolutely need it, they're deciding not to do it. And that's where they're not moving unless life literally forces them to. So you'll hear headlines, you'll hear people talk about, well, hey, you know, there are people that are giving up their 2% interest rates. And that's true. The vast majority of them are only doing it if they basically have to or desperately need to. And listen, these are people that I talk to every day. These are people that are considering making a move to Colorado or making a move within Colorado. And when they're looking at your median home with you know, a smaller down payment, it's still thousands upon thousands of dollars, and you're looking at times mortgage payments between $4,500 to $5,000 a month when you take into account taxes and mortgage insurance and HOAs, it just becomes more than they can stomach. It's not about the fact that people don't want to move. It's the fact that the math is too brutal to make it happen. And I think we should keep in mind that if you're talking about a mortgage payment of $4,500, roughly 3 out of 4 buyers in the state of Colorado and in the Denver metro area are not going to qualify for a payment that high. So who is still buying? Well, as I mentioned, it's the people who technically have to or really need to. You got local buyers with no choice, life events that happen. You got divorces, death in the family, you got new children, you have job relocations. These are people that they just can't wait for better rates to occur. You have, you know, your luxury and wealthy buyers, people that don't necessarily need to wait for rates. Your $1 million plus properties, whether they're buying it with cash, which would be an awesome problem to have, or they're at a point as far as their finances where a 0.5 point of interest isn't going to change their world, so they still make it happen. You also have some selective investors, and these are people that they're pickier now because cash flow is harder to pencil at current rates and prices, but they're still buying if there's an opportunity. They're just not buying anything. And then you have a lot of corporate relocators. You got people in aerospace, defense, tech. I mean, that's still bringing people to Denver. That's a lot of the people that I've helped off of this channel. That's what's happening, and that's still happening. So it's not at pre-pandemic levels, of course, but it is still occurring. And to me, that signifies that Denver has changed from like national competition, where you're competing against people moving from all over the country, to more local competition. Now, you hear a lot about March, like what the heck happened in March? So let's just take a quick frame at this. On February 27th, the 30-year fixed hits 5.99% on average. That doesn't mean everybody got a 5.99%, but that was the average. And again, that's the first time it was below 6% on average since the tail end of 2022. By March 5th, you know, you're over 6%. By March 12th, you're at 6.11. Again, March 19th, it grows. March 25th, we're basically at 6.5. And as of the making of this video, as I look at the average 30-year fixed, it's at 6.62%. You know, again, nationally, that's 63 basis points. You know, 0.63% of interest increased in roughly 30 days. That is a staggering amount, and as I mentioned earlier in the video, about $225,000 a month on your median, I shouldn't say 500, on your median priced home in Denver. So what the heck happened? And obviously, I would assume that a lot of you are already aware of the vast majority of these, but obviously you have the Iran conflict and you have oil prices. So all this activity in Iran, it's pushed oil prices above $100 per barrel. Higher oil means higher inflation expectations, and higher inflation pushes mortgage rates higher. That just constantly happens. We talk about it ad nauseum. So rates climbed, as again of the making of this video, for 4 weeks straight. And that's the biggest 1 week jump that we saw last month since tariffs first rattled the markets in April of 2025. So we saw a massive spike in April of 2025, and we saw a massive spike in 1 week during the month of March. We also continue to have tariff uncertainty, and that's just an ongoing story that we can't really get away from. So broad tariffs in early 2026 are raising costs, excuse me, on builders and builder materials. You're talking lumber, steel, aluminum. The bond market is getting pulled in two directions. You got recession fears, that pushes rates down. You've got inflation fears, that pushes rates up. A lot of fluctuation there. Which direction are we going? Is the economy collapsing, or are we about to face this rash of inflation again that would push rates higher? And the result of all of this is volatility. You can't get a clean trend. For several months prior to March, we saw rates hover in the low sixes, and the housing market improved because of it. Consistency and security really allow people like yourselves to make decisions. The more volatility you see, the more, I would imagine, all of you are watching going, I'm not moving until I know what's going to happen next. And then finally, you have, as many people expected, the Federal Reserve held. So when they met in March, there was no cut. and they're projecting only one cut for the remainder of 2026, whereas earlier predictions had several cuts. Now, you could also make the argument that the Fed has cut rates multiple times, and that really hasn't translated to consistent lowering of mortgage interest rates, and the two are distinctly different. No, don't think that the Fed has control over mortgage rates, but that lack of a cut certainly hurt. Fed Chair Powell's term ends in May. That's a big date that people are paying attention to. So you're going to have this leadership transition, but that right now adds to more of that volatility. So as I mentioned through all of that, these interest rates changes, certainly impact someone's payments. But let's talk about the state of the market, where it actually stands, at least with the most recent data we have. So the February setup looked so promising. You had pending sales that jumped nearly 30% month over month in February. That's the biggest single month jump in recent memory. You had median close prices of $580,000. That was up from January, but it was still 3.3% below 1 year ago, which to me is healthy. I think Denver has needed a housing market and pricing correction for some time. Median days on market dropped from 53 days in January to 33 days in February, a much healthier number. Houses not flying off the shelf, but certainly moving. And then your close to list ratio ticked up to about 98.7%. That meant that if I went to sell my house for $100, it was selling for $98.70. So pretty healthy, all things being considered. Buyers who entered the market in February really got the best of both worlds. They got more inventory, and they got rates briefly below 6%. So a really good opportunity. Unfortunately, at least as of the making of this video, that window is gone. We'll have to wait for it to open again. But what we are seeing is still a continued number of buyers who are still responding to what is real, and that this is a market that is still offering buyers more than it has in multiple years. So your current snapshot, and I'll try to make these really mean something to you rather than just being stats, but your active listings sat at approximately 8,200 to about 8,800. That's up. Depending on the stats you'll look at, anywhere from 7 to 28% year over year, depending on the metric you're using, but certainly several months of inventory, which is beneficial overall. January, you had closed sales of just under 2,000, and that was one of the lowest sales totals since 2008. So there was some alarm bells going off in people's heads. Probably why I think the market just got off to a later start. More people started shopping in February than they typically do. That's why you saw the median single-family home price sit at about $625,000. That was in January. As I mentioned, close-to-list ratio, that sales price to where it actually sells, just a little below 100%, which I think is healthy. During the pandemic, you would constantly see that well over 100%. That is very negative in the long term. 38% of all Denver listings have had a price reduction. In fact, Denver ranks number one among 405 tracked markets nationally for the amount of listings that are having price reductions. Now, that is not the greatest news to homeowners to an extent. I am a firm believer that homeowners, specifically who owned their home prior to the pandemic, if they want to sell their house, they have to give some of that money back. Some of that appreciation gained during the pandemic was an illusion. It was pure magic. It was pure fantasy. Now, if they sell their house, they have to give some of that back. That is certainly going to leave some people vulnerable. We'll talk about that, but overall healthy for the long standing of the market. And then again, as I mentioned earlier, homes are sitting for 35 to 60 days on average, depending on your neighborhood, depending on your market. That is compared to 3 to 7 days in 2021, which was insane. So the case for buyers right now, well, one, listen, you have real leverage, and I'll continue to say that. If you can afford, that's the biggest thing. If you can afford the homes, you have a lot of leverage. More inventory means more choices. You're not forced to compromise on anything. Sellers are offering concessions. They're covering closing costs. They're having price reductions. They're lowering interest rates. You can get an inspection and you can negotiate for inspection items. That is a luxury that wasn't around for a long time. You can take your time to think. You're not in any type of rush. That has been the reoccurring, you're going to hear me say that probably to annoyance in these videos, but that is the case. And if the seller won't negotiate, there are 8 more listings to go take a look at. That's the case in point. The honest reality is that affordability is still greatly strained. There's no getting around that. The qualifying income bar is significantly higher than most people expect. The February momentum is being tested by these, rate increases in March. A lot of people were motivated in February. I mean, at least in my experience, many of them still are, but it's a gut shot. There's no getting around that. Sellers who bought at the 2022 peak have minimal equity, and those are the people that are really vulnerable. When I talk about, some of these people giving back some of this imaginary equity, unfortunately, the people who bought at certain points in 2022 and 2023, those are the ones that are most, vulnerable. They don't have a lot of equity. Attached homes, condos, townhomes, these are underperforming, especially condos. That is a very tricky market right now. Fannie Mae and Freddie Mac came up with some things as far as condos that we'll cover in another video, but condos, still a really tricky situation. Who the market works for, I mean, listen, buyers with 10 to 20% down and solid verifiable income, you're in a good place. Relocators, if you're bringing equity from high cost areas, you're moving from California, Seattle, parts of Texas, a lot of opportunity here. Buyers focused on long-term stability, where you understand that Denver is in this paradox, but there's a lot of positives occurring in the city. And then people who genuinely need to be in Denver. Like, they're not speculating on the market, they just need to be here. Those are the people that this market works for. Now, as far as what this market or who this market is harder on, well, it's harder on first-time buyers with minimum down payment and average household incomes. It's tough. If you're not making a healthy living and you don't have a lot of down payment, it is brutal for home buyers right now. Rate-locked move-up buyers who really can't stand or can't stomach their payment increasing and don't have a lot of equity to move over, that's tough. And then, as I mentioned, sellers who bought at or near the peak of 2022, those are the people that are in a rough spot. Quickly, some questions that I am asked on a pretty continuous basis. And first, are rates going to drop significantly in 2026? I have held firm to the fact that interest rates would stay around 6%. Now, granted, I did not have this Iran conflict in my crystal ball. I would not have guessed that interest rates would be sitting at 6.6% today. If you had asked me, 2 months ago where I thought rates would be, I would tell you somewhere around 6%, which is where we were at the end of February. We'll see how that all plays out. What could bring down rates significantly? Well, I mean, obviously, cooling of the Iran conflict, oil prices per barrel lowering would have a significant impact on rates. Tariff resolution, bringing clearer economic expectations, just knowing here's what the tariffs are, here's what's moving forward, that would be very helpful. Inflation data coming in, consistently lower. Right now, we're stuck around this 3% inflation mark. That's very difficult on these economic factors that play into the 10-year treasury, the mortgage-backed security market. Really leaves us vulnerable. And I would say none of these things are really on the horizon. Unfortunately, I don't know if I could predict any of these things occurring anytime soon, especially if we get boots on the ground in Iran, but I digress. The last thing I'm also asked about is do I think that a lot of remote work will come back because of commercial use of space and things of that nature? I certainly don't think so, and certainly not to the extent that we saw in the pandemic. I thought that was a one-time wave. Pretty incredible for people to be able to choose wherever the heck they wanted to live. But I think that the vast majority of us working in that way is gone now. We'll see how it plays out in the future. What does Denver look like as we move forward? Well, realistically, I see modest price appreciation. I see 1 to 3% annually, which is kind of in consensus with the forecast. It's going to match up to inflation, not much more than that. Not a crash, not a boom, a functioning normal market. Again, I've said that in several videos too, probably gets boring to folks at some point. More sellers are coming to the table on price as spring progresses. More people are understanding that price is the number one factor and they're moving. Days on market should stay pretty consistent. Attached homes will continue to underperform. That's just unfortunately what to expect. Now, we talked about how Denver is cooled, and yes, it has. You have this influx, it had to cool, but what does Denver still have going for it? Well, I mean, to me, this is still a fantastic city to live in. When we talk about quality of life, outdoor access, and a genuinely diversified economy, Denver has it. It's still significantly cheaper than most of your coastal cities. You have a lot of pent-up buyer demand that's real. I mean, people who have been waiting for years are finally saying, you know what, we just need to make a decision. And then you have strong aerospace, defense, tech, finance, education, healthcare. You have a lot of different factors and sectors of employment that are growing here. So where do I land on this? Listen, Denver is definitely going through this change. Denver is going through this process. You cannot be as hot as this city had been for over a decade to basically 15 years and not pay for it at some point. Overall, Denver is not broken. It's not crashing. It's not going to hell in a handbasket. But it's also not going to hand you an easy win in 2026. The math is real. The best thing you can do is make your plan accordingly. But I am a firm believer that Denver's best days are still ahead of it. So if you're thinking about moving to Denver, listen, I would run your numbers. I would have as many conversations with people as possible. Certainly here myself to be a resource in any way I can. Again, my number and email on the screen if I can ever be of that. We are in for multiple months yet and potentially multiple years of this challenge and of working through it. But heck, I'm here to work through it with you, and we'll see how things play out. This is Destination Denver, Colorado. I'm your host, Jimmy Everett. That was your Denver housing market update for the month of April. Until I see you next time, peace.